Every founder loves the word bootstrapping. It sounds gritty, noble, independent, and it works for the first few years. You learn discipline, you stretch every dollar, but at some point, bootstrapping turns from a strength into a ceiling. Kaufman Foundation tracked 10 years of self-funded companies. Average annual growth rate about 12%. Companies that raised structured capital grew over 40% per year on average. That compounding gap becomes enormous over time. A $1 million company growing 12% hits 1.76 million in 5 years. At 40% growth is over 5 million. That's where slow money costs you. Founders think they're saving equity by not raising funds. What they're really doing is paying a slow money tax. Every month they stay undercapitalized, they lose market share to someone who isn't. I worked with a digital marketing agency that had been bootstrapping for 8 years. They hovered around 2.5 million in revenue. Each time they tried to scale, cash flow choked them. They finally raised 400,000 through a small investor group, used it for hiring, automation, and a real sales department. 18 months later, revenue crossed 6 million and margins improved. The founder still owned 85% of the company, but now the pie was 3 times bigger. That's the real trade-off. A smaller slice of a much larger pie beats full control of a stagnant one. Now, why do founders cling to bootstrapping? Fear and misinformation. Fear of losing control and misinformation about investors. Most investors don't want to run your business. They want to see it scale responsibly so their money multiplies. If your systems and governance are solid, they'll happily stay hands off. Let's quantify the risk of staying small. According to the U.S. Chamber of Commerce, 80% of small businesses reinvest less than 10% of revenue into growth. That's why so many plateau around the 2 to 5 million range. Meanwhile, businesses that reinvest 20% or more grow nearly twice as fast and attract premium valuations. Capital is the engine behind that reinvestment. Imagine a $3 million construction firm wanting to grow 30%. That's $900,000 in new revenue. To handle that, they'll need roughly $300,000 in working capital for labor, materials, and marketing. If they want to save up from profit, it could take 3 years. If they raise it through a Reg CF or other private investors, they could do it this quarter. 3 years versus 3 months, that's the cost of bootstrapping. Here's another angle, risk. Founders say debt is risky, but so is stagnation. Inflation erodes your retained earnings every year you wait. And when competitors raise capital, they outspend you on marketing, recruitment, and technology. Their risk is leveraged into growth. Your compounds into obsolescence. I'm not saying take reckless money. I'm saying plan your capital strategy with the same precision you plan sales targets. Start with these 3 questions. What is your annual growth goal in dollars? How much capital does that actually require? What's the cheapest, smartest way to acquire that capital without hurting cash flow? If you can't answer those questions, you're operating reactively. Bootstrapping feels safe because it's familiar, but safety and sustainability are not the same thing. Let's look at companies that scaled during tough markets. Between 2020 and 2023, businesses that raised expansion capital despite high interest rates outperformed peers by 27% in EBITDA growth, according to PitchBook. They bought talent when others froze hiring. They expanded marketing when competitors cut budgets. They moved while everyone else waited. That's strategic courage, not recklessness. If you're worried about dilution, remember this. Ownership is a control lever, not a religion. You can design investor agreements that preserve decision rights while still unlocking cash. Convertible notes, preferred shares, revenue-based agreements, these are tools, not threats. The real threat is paralysis. Bootstrapping teaches discipline, but capital teaches leverage. And leverage is how small businesses become enterprises. So here's your action plan. Calculate your slow money tax. Take your growth goal, divide by how many years you've been flat, and multiply by your margin. That's the profit you forfeited by moving too slowly. Map your capital gap. List every growth initiative you delayed because of cash. Explore capital sources. Crowdfunding if you have a loyal customer base. Private investors if you have predictable returns. Debt lines if your revenue is steady. Whichever path you choose, do it intentionally. Bootstrapping isn't bad, it's just incomplete. It's a phase, not a forever strategy. If you're ready to graduate from surviving on cash flow to scaling with capital, visit our website, webinar.capitalraisingacademy.com, and join our free masterclass, How to Raise Capital the Smart Way Without Losing Control of Your Business. You'll learn how service-based businesses are funding growth now, legally, strategically, and without losing control. Because independence isn't about doing everything yourself. It's about building something that no longer depends on you to survive.